Can we start, Aman?
Sir, 2 minutes.
Okay.
1 minute. So we can go ahead.
Okay.
We are
Thank you,
live.
Aman. Great. Good evening, everyone. I welcome you all again to our session on GST Back to Basics. Today we'll be covering the topic on of input tax credit under GST. We'll be going through some basic provisions, the enabling provisions for the levy of GST. I've just kept the outline of today's session as to what we intend to cover into four different baskets. One is the enabling provision and important definitions, matching of credit, an important concept under GST, procedural aspects relating to claim of credit, and some special provisions under GST, including those relating to capital goods. Uh, Friends, before I begin, since it's an introductory session on input tax credit, I think it is important for us to understand and appreciate that input tax credit is one of the most important element or one of the most important pillar of the GST law. Why? Because it is one of those elements which helps us as a business to reduce our output tax liability. It's available as an offset against our output tax liability. And therefore, it's a benefit which each business is claiming. Therefore, it becomes more important to ensure that the benefit which we are claiming is correct in law. Because anything, if in future it transpires that we have claimed a wrong benefit, wrong input tax credit, that will have consequences in terms of interest and probable penalty, apart from recovery of the base amount of benefit taken itself. What is the benefit? One fundamental aspect in the GST is that input tax credit is a statutory right given to the SSC. It is a part of section, unlike central aspect where it was under the Senate credit rules, and therefore it was an dispute of whether it's a vested right or not. All those aspects gets taken care of under GST. It's a right which is given to us by the statute. I would request everyone to please mute your. Aman, please mute everyone except me. I would request our participants to kindly mute your speakers. Huh. So we begin first of all with enabling provision. What entitles a taxpayer to claim input tax credit under GST? Those enabling provisions are contained in the section 16, subsection 1 of the GST of the CGST Act 2017. We have similar provisions under the State GST Act also, and the CGST provisions are made applicable to the provisions of IGST. So first of all, section 16.1 says that every registered person. So the first fundamental condition for claiming input tax credit is that the person needs to be a registered person. Now, what does a registered person mean actually? A registered person means a person who has obtained registration under the GST. So it would therefore imply that a person, if he is unregistered, he cannot claim input tax credit. That is the first condition. Under the GST Senate regime, we had a lot of challenges on this part, where prior to registration period, if you could claim credit or not, there was a lot of dispute from the tax authorities. We had a decision from the Madras High Court in Karnataka High Court in M portal, where it was held that there is no such requirement in the Senate credit rules that registration is a prerequisite for claiming ITC. But here under section 16.1, it is a starting condition. The law clearly says that a person has to be a registered person in order to claim ITC. So we have to be very careful that when we are claiming registration, especially when we have opened a fresh branch in a new state or opened a new company, we ensure that all the expenses are incurred only after the registration certificate is obtained. If the purchases are prior to registration, date of registration certificate, input tax credit will not be available, especially on input service and capital goods. For inputs, that is what goods we purchase for our business activity and which are not classifiable as capital goods, input tax credit is available if their goods are held in stock on the date of obtaining registration certificate and the goods are not more than 1 year old, just like a condition which we get for transition credit. So we have to note that pre-registration period input tax credit is available only on inputs, that is goods purchased which are not classifiable as capital goods, and those goods should not be more than in your stock for more than 1 year. This takes to the second condition. It says every registered person shall, subject to such conditions and restrictions as may be prescribed. So there are certain conditions, there are certain restrictions which will be prescribed under the rules or notification. Be entitled, and in the manner specified in section 14.9, be entitled to credit, to take credit of input tax charged on any supply of goods or services or both to which are used or intended to be used in the course or furtherance of this business. So as we can see, these are the seven conditions or seven parts in which the enabling section can be divided. I'll just repeat. Firstly, the condition is that the person who is claiming the input tax credit needs to be a registered person, and he can claim input tax credit in respect of supply of goods or services or both which have been made to him, which have been received by him, and these input services or the input supplies of goods or services should be used or intended to be used in the course or furtherance of his business. These are the important aspects here which we need to keep in mind. Therefore, first element which comes into mind is all non-business expenses we are not eligible to claim ITC. All non-business expenses, we have a separate slide discussing those. We'll do it some time. And then there can be also examples of whether incorporation expenses are eligible for input tax credit, or discontinuation of business, or winding up expenses are eligible or not. All those aspects we'll be discussing sometime. But this is the overall structure of the GST law which entitles you to claim input tax credit. And lastly, what happens is the amount which you once claimed will be credited to your electronic credit ledger. This is like your bank account with the government, only it's not in the form of money, but it's more in the form of electronic credit ledger, input tax credit. We had similar concept under Senvet regime also, where we had the Senvet credit passbook system. Same concept continues here also. As I said, the important definitions which are coming here, registered person is the most important definition. It says that it means a person who is registered under Section 25 of the GST Act or the CGST Act, but does not include a person having a unique identification number. This applies for the unique identification number is a concept which is applicable for embassies and diplomatic organizations. So it's not very common. I think it's not applicable to any of us. So in general, if I am registered under the GST Act, so a person who is liable to be registered but not registered, he is not a registered person. Registered person means a person who is registered under Section 25. It can be either on mandatory registration, meaning my turnover has crossed the prescribed limit, or voluntary, meaning if I'm starting my business today and today itself I go and take registration, though my turnover is not crossed, I will be treated as a registered person for the purpose of GST law, for the purpose of claiming input tax credit. Now I will again repeat what I said in the starting of my session. When I'm a registered person, there can be cases that from the date of that when I obtained the registration, the date effective date of my registration is X date, let's say 1st December. But on 15th November, I have incurred certain expenses. Can I claim input tax credit? This applies especially in case of new companies which are incorporated. So I will repeat again, pre-registration ITC or credit of tax paid on pre-registration supplies is eligible only to the extent of inputs which are held in stock either in as is condition or as finished goods or as work in progress, and they are not more than 1 year old. They should not have been held in stock for more than 1 year. Please note that. So input services, capital goods, they are not your input service capital goods. They are not eligible for pre-registration period input tax credit. Pre-registration input tax credit is eligible only for inputs, and again that is subject to conditions under section 18(1), 2 and 2. This takes me to the next definition of input tax credit. Again important because this is what we are discussing about everything. There are two definitions. One is input tax credit itself, which is very loosely defined or very plainly defined to mean credit of input tax. But what is input tax is important. It defines input tax to mean central tax, state tax, integrated tax, or union territory tax charged on any supply of goods or services or both made to him, and includes the integrated tax paid on import of goods, tax paid under reverse charge, both under the CS or IGST Act, and it does not include tax paid under the composition levy. Meaning, if you are purchasing goods from a person who is under the composition scheme, and those are not allowed to charge tax only, but if they charge, you cannot claim input tax credit. It would be wrong on their part, of course. So that is one important aspect. Now, when we look here, there are mainly three baskets of taxes which are classifiable as input tax. One is central tax, state tax, and integrated tax. And when I say state tax, we should also refer to it as an UT tax also if you are in a particular union territory. Now, when we look at central tax, it is a tax which is charged under the Central Goods and Service Tax Act, which is a single legislation. Same way, IGST Act, the integrated tax, is a tax which is charged under the Integrated Goods and Service Tax Act 2017, again a single legislation. But when we look at state tax, there are X number of state tax X, because each state has its own SGST Act. Maharashtra has its MGST Act, Gujarat would have its GST Act, and so on. And therefore, it becomes important to refer to the definition of each of these tax. Again, we will see central tax, they will say, means a tax levied under the CGST Act. State tax levied under any state goods and service tax Act. Okay. And integrated tax means state tax levied under the IGST Act. But there is one lacuna here. I think there's something wrong. But the state tax, the CGST Act is defined to mean the tax which is levied under the respective state GST Act. So there is perhaps a printing error. So what it transpires is that if I am in Maharashtra and a vendor from Gujarat has charged me Gujarat GST Act, it does not classify as input GST for me. It is not my input tax for me, and therefore we say that in specific cases of hotels where the source location tax is levied, the POS is the source location where the hotel's address, we say that you cannot claim the input tax credit. We have just taken one issue here, which is very common in industries where a lot of travel is involved. ABC is registered as a taxpayer in Maharashtra. Its employee travels to Gujarat for official purposes and avails hotel accommodation services. The employee has provided ABC's GST to the hotel, and the same is mentioned in the tax invoice, but the hotel is charging CGST and SGST. Because for hotel accommodation, the place of supply is Gujarat. Now, location of supplier would be Gujarat. Place of supply is also Gujarat. So, Gujarat supplier has to charge you CGST and SGST. The question that remains is, even though this credit is appearing in my GST at 2A, can I claim the input tax credit? The answer would be no. Why? Because the state tax, like I said you, it's defined to mean the tax charged under the respective state GST Act. Now, I want to claim credit under the Maharashtra GST Act for the state tax component. And therefore, Maharashtra tax officer is not going to allow me credit where the tax is charged under the Gujarat GST Act. However, had this been a case where a supplier is in Gujarat, customer is in Maharashtra, but place of supply is in Delhi for some reason. In such a case, since IGST will be levied because the supplier in Gujarat, POS is place of supply is in Delhi, the applicable tax is IGST. That case, we have a strong basis to argue that integrated tax there is only one IGST Act, and therefore that qualifies as input tax credit for me. So the thumb rule in any organization should be that when we are looking at eligibility to claim ITC, if the supplier is in a different state and he has charged you CGST and SGST, you should not claim that input tax credit. If he has charged you IGST, you can claim that credit, but please note that is also subject to litigation. We have seen cases where ITC has been sought to be denied by the tax officers merely because the place supply is not in the location of the recipient. Please note there is nothing in the legislation so far to support that such an argument, but we have seen notices, so we have to be cautious on that front. This takes us to the next important content requirement for claiming credit, and that is that the supply should be in the course or furtherance of his business. Which if I want to claim an input tax credit, I should have received the supply of goods or services or both in the course or furtherance of my business. Now, this takes me to some specific examples of what can be said or what cannot be said to be in the course or furtherance of my business. First example which I would take, and this is which has been in news of late, is whether CSR expenditure can be said to be in the course or furtherance of business. Why this question comes? Those incurring CSR expenditure is a business requirement, especially under the Companies Act 2013. So why is it relevant? This question. Now, under income tax, if you go, then there's a problem because Section 37 clearly says that this is not an allowable expenses. So, and based on that particular course, and if you refer the CSR requirement, CSR guidelines, they also clearly say that the expenses which are incurring towards CSR should not be relating to your business; it should be relating to social causes. Therefore, there's a strong case to say that CSR expenses are not eligible for input tax credit. Though we had a decision under the Soviet regime in SL Propec which said that it is allowable, it has been recently overruled by the division bench in Delhi Tribunal, and therefore that also is not a good law as on date. We also have a lot of conflicting advanced rulings. Of course, it is not applicable to. It does not have a universal applicability, and it's applicable only to the person who is the applicant. still officers have been, it has been seen that officers rely on those readings which are actually favorable for them and against further SSC. This takes to the second question, whether expenditure incurred for increase in share capital, IPO, etc. by company can be treated in the course or further of business or not. Again, IPO is a route for raising capital, and therefore, in my view, it should be eligible for input tax credit. Even in income tax, we have sufficient case laws to say that these are all eligible expenditure. However, there's one catch here is that when the IPO is by an OFS route, meaning that's an offer for sale route, the company does not raise any fresh capital. It only sells, only the promoter offload that stock in the market. In those cases, actually, whatever expense has been incurred by the company, it is not for the company itself, but it is for the promoters, and therefore that expense may not be eligible for input tax credit because that is not in the course of furtherance of the company, but rather it's in the course of furtherance of the employer's promoters investment. So there is one this particular case which we have to keep in mind when we're dealing with IPO. That is whether the IPO is by OFS route or fresh issue. The company is raising fresh capital. Uh, this takes me to my next requirement. As we said, look at section 61. They say that the claim of input tax credit shall be subject to conditions and restrictions prescribed. Today we are going to talk about the conditions which are prescribed. Now, when the restrictions we have planned for the next session will be taken by Darshan. So today, what are the conditions? The first condition is that the recipient should be in possession of a tax invoice or debit note issued by supplier registered under this act or such other tax paying document as may be prescribed. This is very important. Uh, and every time we are looking at, we also see many show cause notices where officers at the time of investigation or audit ask for some invoice copies. We have not been able to provide due to it being old time period or something like that, it being very old document, and then that has resulted in raising of notices to taxpayers on SSC saying that you do not have documents in your possession, so we are disallowing the sale. Same situation may continue under GST regime also. One saving grace for this particular condition is that in GST, even a soft copy of the document is a valid document. So it is advisable that wherever possible, especially in larger organizations where you have sufficient, you have the logistics to handle it, ensure that all input tax credit documents are scanned and kept somewhere safe so that they are easily retrievable at the time of audits. We all know audits don't take immediately; they come after 5 years, and so it's more the important that we have sufficient database available with us to take care of that. Again, if you look here, they are saying that you should be in possession of a tax invoice or a debit note issued by supplier registered under this site. So the document has to be, in case when you're buying any supply, you are receiving a supply from a registered person, it has to be a tax invoice or a debit note only based on which you can claim the ITC. And in other cases, they have also said that for some other cases, we'll be prescribing the tax paying documents. Prescription again has to be by rules, and the Rule 36(1) prescribes this document. They have said that an invoice issued by the supplier of goods or services or both in accordance with the provisions of Section 31. An invoice issued in accordance with the provisions of Clause F of subsection 3 of Section 31. This is very important. As you all are aware, Section 31 3F requires that when we receive supplies from a unregistered person which attract reverse charge, you have to prepare a self-purchase invoice, a self-purchase document, and maintain that in your records. At the time of audit, officers can ask for those documents, and if you are not prepared on daily basis, it is possible that your ITC claim on RCM tax paid might be denied. Again, please note, reverse charge mere document self-invoice is not sufficient. The same would be subject to payment of tax. Meaning, after preparing the purchase invoice, you also have to make the payment of tax, and only then will your claim of input tax credit be sufficient. Third, a debit note issued by supplier in accordance with the provisions of Section 34. Fourth, a bill of entry or any similar document prescribed under the Customs Act or rules made thereunder for the assessment of integrated tax on imports. Bill of entry is required. At times, we have seen that bill of entry was assessed at a lower rate of IGST, and then taxpayers realize that mistake, they go for reassessment, and they only pay by TR6 challan. We would believe that TR6 challan is also sufficient documentation, but it is always advisable that you try to get the bill of entry rectified, amended, and correct documents are mentioned so that there is no mismatch. Please note, when we are claiming ITC on import of goods, there is a correlation with IceGate data. So they compare IceGate data and your purchase register or a GST 3B. So at that point of time, if there is any mismatch, we will end up having notice from the jurisdiction office. So it is always important or better that whenever you are claiming on import of goods, the bill of entry data is that a subsequent amendment and you end up paying higher IGST, you get the bill of entry amended, you go talk to your CHA and say that you please get it rectified so that there is no mismatch going forward. Lastly, an input service distributor invoice or input service distributor credit note or any document issued by an ISD. So again, ISD is the concept which is applicable for head offices which are receiving supplies for all the locations. They can distribute the credit to the location. So that ISD invoice has to be, you can claim based on ISD invoice also. Next important part is that all these documents which are looking at, it should contain the particulars that are prescribed under Chapter 6 of the state rule. So if you remember in the last session, Aman took you through the various documentary parts of an output on the output side. We have to ensure that when we receive an invoice from our supplier, all those particulars mentioned therein are incorporated here. For example, if we know that a supplier is required to comply with invoicing, we should ensure that we follow up with them and make sure that they have complied with invoicing. For example, if you know that a large supplier is required to comply with invoicing and is not complying, or you make sure that you have obtained assurance from him that he has complied with the invoicing, or if not he complied, at least take an indemnity from him that if in future your input tax credit is denied on account of his non-compliance with the provision, he will reimburse you the losses. Again, these requirements are similar to what we had in GST and standard credit rules also, but there are exceptions that if the basic documents are available, basic details are available in an invoice, the claim of input tax credit may not be denied. This takes me to the second condition of matching. This condition, which is by way of clause AA to section 16.2, has been inserted only with effect from 1st January 2022. If you recollect, friends, that when GST was introduced, we had an elaborate process of filing credit, of filing returns, of claiming credit, which included, you filing GST, your supplier filing GST 1, the details coming to you by GST 2A, a recipient then accepting, modifying, or rejecting, or marking pending the supply which is coming in GST 2A. The mismatch is going back to supplier in GST 1A, and then you filing your GST 3 based on entire matching process. But we have ended up with a situation where we have only GSTR 1 and GSTR 3B. We had GSTR 2A coming in a bit late, but again, its relevance is right away with GSTR 2 and 3 being out of picture. Still, the tax officers have not appreciated that aspect. We have received lots of notices on GSTR 1, on GSTR 3B and GSTR 2A mismatch. But there are apprehensions that those notices may not be legally sustainable. Perhaps the government understands that aspect and therefore they have introduced a new clause, this particular clause which we are looking at, which says that the details of invoice or debit note which are referred to in clause A are or should have been furnished by the supplier in his statement of outward supplies, in his GSTR 1, and those details should be communicated to me as a recipient in my GSTR 2B. So this means there will be 100% matching of credit. With effect from 1st January 2022, any ITCI claim, there has to be 100% matching. So the buffer which we had under 5%, 10% is gone. So again, it's very important for taxpayers, especially who are claiming ITC, to ensure that before filing GST 3B, we do a 100% matching of input tax credit claim. There should not, and for doing that, there is a primary requisition that we should have a purchase register, a proper purchase register. We know many SME clients, many SME taxpayers have a practice of just taking the balancing figure from the CGST balances, from the tax balances. Those days are gone. We need to have a proper working on a month-on-month basis, a proper reconciliation statement with GST 2B. Take note of the timing difference, meaning something is happening now 2B for this year in this month, but it might pertain to a previous month, or we have accounted in the next month. Keep all those tracks in mind. Pass proper accounting entries for the matching process. Matching is very important, and I will tell you, if input tax credit is an important pillar of GST, matching of input tax credit, though a subset, is now a more important part of the entire process, and we have to be very careful. There are timelines attached by which we have to claim credit. We need to be more proactive with our vendors, follow up with them for ensuring that all mismatches are communicated to them, proper documentation, and required corrective actions should be posed on them. Okay, this also means that when I say matching, till December 21, we had an option to claim 5% of, we had a buffer of 5% of 5% to the effect that, if 100 rupees is appearing in my GST at 2A, I could claim 105 rupees as ITC. That buffer has gone. Please note that. Rule 36.4 to the effect that it gave 20% or 10% or 5% buffer is no longer applicable. It clearly provides that credit can be claimed only if it is appearing in your GSTR 2B. Please take note of that if you are still continuing to claim Rule 36.4 benefit of the earlier provisions. Please take the corrective actions, get it rectified. We have time till September to rectify any error in filing GST 3 before 21-22. Again, a very important condition. The GST law says that you should have received the goods or services or both in order to claim input tax credit. If you have not received the goods or services, your claim of input tax credit will be gone. And in many cases, we have seen this that where some supplier has been identified as being a fraudulent supplier or hawala supplier, or even if it's a genuine supplier, but he has not filed his GST 1 or GST 3B, tax authorities are issuing notice merely on the presumption that there is a non-receipt of goods or services by the recipient, and therefore ITC is deniable. Therefore, we have to also ensure that the goods or services are received. Now, how do we track it? So far as goods are concerned, I would suggest that we have proper documentation relating to actual movement of goods from the place of supplier to our supplier. Fast track data is also sufficient. Also, a good source to confirm that yes, there's a movement of goods. That should be supporting e-way bill wherever applicable. If required, toll receipts or something like that is always helpful for us to demonstrate that yes, I have received the goods so as to be able to claim input tax credit. So far as services are concerned, we have a bit of a challenge. Services being intangible in nature, we cannot track as such, but again, there are documents like service completion reports and all, which we can keep as a proof to demonstrate that yes, you have received the services. Again, you have to note that this condition is actually not a prerequisite for claiming input tax credit. There's a strong basis to say that this condition, the actual compliance of this condition can take place in past, in subsequently also. For example, today if I book a ticket for airline, an air ticket, I have not received the service it's per se today. I have received an agreement. There's an agreement to provide service, but not actual provision of service. Still, I can claim that ITC today because there is a commitment that I will be in future receiving the service from that airline. So this is one aspect which we all have to keep in mind. Similarly, in case of goods, there are times when the goods are received in lots or installment. In such cases, the actual receipt of goods is deemed to be completed only when the last lot or last installment is received. Please note that it is not on, one, if let's say if the goods are received in 10 installments, the first 5 installments are received in 1 month and the balance 5 installments are the next month. You cannot claim IT proportional ITC for the first 5 installments in the first month. You have to wait till all the 10 installments are complete, and only after that, on the basis of receipt of an invoice for supply of 10 installments of goods, you can claim the input tax credit. Yes, but this will not be applicable if in a case that if you have 10 installments, the supplier says that I will raise you separate invoice for each installment. If that is the case, you can claim credit for the 5 installments which are issued in 1 month, provided the invoice has also been raised to you. In some cases, there's also deeming provision that there's a deeming fiction that you have received certain goods or services or both, and this would take you all back to the concept of even issue under GST under VAT regime, VAT or in fact CST regime. Just a second, which say that you could have a bill to ship to model, so the second sale was not liable to CST again in case of interstate movement of goods which are under the bill to ship to model. Same way here they also that in case of bill to ship to model, the middle party is deemed to receive the goods or services. So, for example, A is in Maharashtra, B is in Gujarat, and C is in Rajasthan. B places an order on A in Maharashtra that you please raise an invoice to me for supply of these goods, but the goods are to be delivered to C, and B will bill directly to C. So here A will raise an invoice to B saying that the goods are shipped to C. B will again raise an invoice to C saying that the goods are delivered to you by A. The question or the confusion that was that whether B can claim this input tax credit or not. So that has been clarified by this deeming fiction which says that in case of bill to ship to model, the bill to party shall be deemed to have received the goods. Same context might apply in the service also because there's a concept of trading in service, like internet recharge vouchers for telephone or broadband or D2H. Again, in those cases, they have clearly said that it's a bill to ship to model. It is assumed That bill to party is entitled to claim as received the goods or as received the service, and therefore they are eligible to claim input tax credit. This takes me to some other conditions which are there under 16(2)(b). If GST to be generated from the portal restricts the claim of input tax credit. As you all know, we also have a new form coming from the portal GST 2B. It's a different version of GST 2A. And the difference is that GST 2B is static, means once generated, it does not change for that particular month. It The subsequent entries are appearing in the next month GST 2B. That portal, the report also identifies certain transactions as restricted ITC. One such example is where the party has filed GST1 but not filed GST3B, or there's a POS mismatch. Let's say the supplier is in Gujarat, recipient is in Maharashtra. The supplier has said that the POS is Gujarat only, meaning he has charged CGST and SGST. Take an example of hotel case. All those might come in the restricted category, and if it's in the restricted category, you cannot claim input tax credit. Third, supplier should have paid the tax charge in respect of supply. This is again important condition. How do you demonstrate the supplier has paid tax? The supplier should have filed his GST at 3B. That is very important because generally there is also a apprehension that whether the supplier has correctly disclosed the turnover or is in his GST at 3B or not. That we cannot check, unfortunately. There is again a condition under the law now, a new specificity where they will say that how much ITC a supplier is paying by credit, how much is paying by cash, which they give percentage breakup. But again, that will not satisfy this particular apprehension of the obligation on the part of recipient. Though the government has tried to amend the laws regularly, they have made it compulsory now that that a turnover which is disclosing GSTR 1 should be the minimum liability which you are paying in GSTR 3B. That is a self-assessed liability in GSTR 1. That amount is now auto-populated in GST. So it is expected that that supplier will at least pay that much tax. Last, recipient should have furnished the return under section 13(9). Again, this is the last condition under section 16(2). What does this condition say? You should have filed GSTR 3B in time. If you have not filed GSTR 3B, you have not claimed the input tax credit. If you have filed GSTR 3B late after the prescribed date, which will come in sometime, again your ITC is in challenge. So please note, claiming of input tax credit is a requirement for claiming the credit. Filing of GST 3B is a requirement for claiming credit. It is a primary requirement. If GST 3B is not filed, credit cannot be claimed. This takes me to some other conditions. There is one more condition which we all are common, which we all should be aware that from Senate regime also it was there. And the condition says that the payment to a supplier should be made within 180 days from the date of invoice. If you do not make payment to a supplier within 180 days, whatever ITC you have claimed will be liable to be reversed to the extent not paid. So what does it mean? So let's say if I have claimed a credit of 18 rupees from a supplier A and I have not paid in the entire consideration, let's say 118 was the invoice value, I have paid him only 59 rupees and 59 rupees are pending to pay him. Then I have to do a reverse working on the unpaid amount of 59, determine the GST component and reverse that GST under the applicable head. It can be either C plus S or IGST along with interest. There is a catch here. It has to be reversed along with interest. Okay. When there is a failure to pay to a supplier. Again, the first three words, failure to pay is very important. Failure to pay would entail that, when there's a liability to pay, let's say our agreement says that I have to pay in 1 month and I fail to pay. That is known as failure to pay. But if it is a case where the payment terms itself says that I have to pay after 6 months or after 1 year, that may not be counted as a failure to pay. Other cases of failure to pay or a situation is not covered under failure to pay may be contractual obligation. Like many times in case of works contractors and government contracts, there's a retention clause which says that after you complete the service, we will retain your 5% of your consideration, 10% of whatever may be the case, and that will be paid to you after 2 years of time, because they have to maintain some quality insurance and all those matters. In those cases, it can be strongly argued that it's not a case of failure to pay. We have a judgment of Rajasthan High Court in case of Hindustan Zinc Limited, which may be of help here. Again, one more point which we need to note here is that interest, as I said, interest is payable. So how to safeguard yourself from interest? So many times what we do is we advise clients that if you are a credit-rich company, if you have a sufficient credit balance, in such cases, and if you know that this ITC which I have claimed, I'm not going to pay my vendor within 6 months, you don't claim ITC, or you claim the ITC, and reverse in the same month, and you reclaim as and when you make the payment in future. In such a case, you are safeguarding yourself against interest. But if you are not a tax, credit rich company, you always end up paying balance in cash, your tax liability in cash. That may not be a workable solution. At times, clients also ask us that I always have sufficient balance with me. So if there's a need for me to reverse my input tax credit because of non-payment, can I argue that interest is not payable? I would believe it's a difficult proposition because as you can see, Rule 37 under which this particular provision comes, 37.3 and Section 16 to proviso, it says that the amount of input tax credit which is attributable to unpaid consideration is to be added to your output tax liability, and therefore when it is something added to your output tax liability, that gets covered by Section 51, whereas interest on convert credit input tax credit is by Section 53, and therefore it will be very difficult to uh, counter that the levy of interest on those cases. It can always be argued, but we believe that the chances are not very strong to contest that. It's the same. Lastly, we can reclaim. Let's say after 6 months, if I have after once I reverse the ITC, after 2 months I again pay back the vendor. The ITC component can be reclaimed. The interest is a cost. How to calculate? Again, now there can be cases is that I have an invoice which is dated 1st January 2022. The 6 month period ends on 30th June 2022. So if I have not paid the vendor by 30th June 2022, while filing my June 2022 return, I will reverse the credit. Provided I have claimed the credit, that's the first condition which you need to ensure. And number two, the interest is to be calculated not from the date of invoice, but from the date of filing of GST at 3B of the month in which you actually claimed the credit. So it may also be possible that the invoice date is 1st January, but you account it only in March or April. In that case, interest will be restricted to 2 or 3 months. It's the case maybe. Please keep this point in mind. I have one query that in case if I have sufficient cash balance available, is interest still applicable? Again, that is all debatable, especially for cash balance, because cash balance in electronic cash ledger, it is not actually payment of tax. And again, it can be argued by department that you have to pay interest. We already are facing one such show cause notice from the department on this matter. This takes me to the next point of time limit to claim input tax credit. As I said, under service tax also we had this condition settlement regime where it said that you have to claim the input tax credit within 1 year from the date of invoice. Under GST, we have a better condition. They have said that no input tax credit can be claimed after the due date of furnishing of the return under Section 9 for the month of September following the end of financial year to which such invoice or debit note pertains, or furnishing of annual return for the relevant financial year whichever is service. So what does it mean? It means that for, let's say you have an invoice dated 1st April 2022. So if you want to claim that credit, the same has to be claimed on or before 20th October 2023. Okay, so any GST review filed before that date, you can claim the credit. After that date, you cannot claim the input tax credit. I'm not stressing more on the second part of the condition or the definition, which is furnishing of annual return, because that generally comes on the later part. That is generally in December. So it may not be that relevant for this. So please note, any financial year of which the invoice pertains, the outer time limit to claim input tax credit is 20th October of the next financial year. Are you with me? Same applies for debit note also. The date on which the document is issued, be it invoice or debit note, before 20th October of the next financial year, you should claim the input tax credit. Okay. This takes me to the last part of today's discussion. Some special provisions relating to capital goods. Capital goods means what? When we purchase any goods which are capitalized in the books of accounts, they are treated as a capital goods. And the first condition for claiming input tax credit on capital goods is that if you want to claim input tax credit, you cannot capitalize the ITC component and claim depreciation under the Income Tax Act 1961. This is the first condition which you have to satisfy. So under Income Tax Act, you should capitalize only the base amount and not the tax amount. If tax amount is capitalized there, you will be liable to reverse the ITC claim. Second is the case of where you save the capital goods within 5 years of purchase. Again, this condition is applicable first of all only when I have claimed input tax credit. If I have not claimed input tax credit, this condition is not applicable. What this condition says? There it says that any capital goods once purchased shall be deemed to have an useful life of 5 years. And if the asset, if the capital goods is sold within 5 years, the unexpired or the undepreciated input tax credit claim shall be the minimum amount which is payable on the sale of such capital goods. Okay, let's say I have taken ITC of 1 lakh rupees on a capital goods. After 2.5 years, there is once the asset reaches mid life, I decide to sell it for some amount. The provision says that the minimum tax liability which is payable should be rupees 50,000. So if I have sold it for that only rupees 1 lakh rupees, so the 18% on that is 18,000. Then I will have to say that the taxable value is 1 lakh rupees, but the applicable GST on the same supply is 60,000 rupees because undepreciated component is you have claimed the ITC, you have taken the benefit of that ITC. So now you cannot you cannot have a situation that first I claim ITC and then I sell it for a lower price. This condition applies only for capital goods, please note, and not for other cases. Okay, so this is very important. We have to keep track, and especially now that we are into 5 years into GST, there would be many cases that assets purchased after GST was introduced are now due for sale, and so we should take care of this aspect very much. This is applicable only also in cases where we apply for cancellation of registration. Again, if we discontinue our business for whatever reasons, and we have taken ITC on capital goods during since the introduction of GST, we will identify how much credit is attributable to unexpired ITC claim, and that amount will have to be paid either in cash or using the balance lying in the credit ledger. Please note this is very important. Lastly, again, permanent transfer or disposal of business assets where input tax credit is claimed is deemed to be a supply by under the GST law, even if made without consideration. So this would also include cases where a proprietor, let's say, has purchased some capital goods, claimed input tax credit, but now he says that I'm going to use it for my personal use, so I will debit it to my capital account as drawing. In those cases, that is deemed to be a supply. You are required to pay GST on the output side. So that's all from my side. We will open the forum for discussion. We have 2 more detailed sessions on input tax credit lined up for the next Tuesday, next 2 Tuesdays. We will be looking, the sessions will be taken by my partners, Darshan Ranawat and Yash Parmar. If we have any queries, we will open the forum for the audience. Aman, do we have any queries? Okay.
None as of now, sir.
Okay. I think if we have allowed them to unmute them, right?
Yes, sir.
Okay. I'm sure all of you have my contact details. You can connect with me or with respect to partners at any point of time for any clarifications required. Thank you all for a patient hearing and your resounding support to this lecture series. We look forward to see you again on next Tuesday when we again discuss some more procedural provisions relating to ITC. Thank you very much and have a good day.